Welcome to Clever Money Hacks, the channel where money moves and life improves. In today's episode, we'll be discussing a really fascinating conversation from the Diary of a CEO about wealth, discipline, and some of the hidden rules of the financial game.
It's great to be here. Most of the time when you talk about personal finance, it's a lecture on what you can't do.
Right. Don't buy this. Cut back on that.
Exactly. It's all about deprivation.
Hmm.
But the source material we're digging into today, it completely flips that. It looks past simple budgeting and at the big levers, the things that actually build your net worth.
Yeah, that's our mission for this deep dive. We really want to just debunk that classic advice, skip the coffee to get rich.
Oh, now one.
It's everywhere, and frankly, it's just not that helpful. So
Yeah.
instead, we're going to look at the real trade-offs like saving versus investing, the hidden flexibility in things like insurance, and the pretty surprising ROI of your relationships.
And that's the core of it, really. It's a mindset shift. Most of us are taught to solve for cost. It's a scarcity mindset, basically.
Making your life smaller to fit your paycheck.
Exactly. But what these sources argue is you need to solve for income, an abundance mindset. It sounds like a small change in words, but the outcome is, well, it's massive.
Okay, so let's get right into it. The latte myth. We have to start there. Every financial guru says, stop that $5 coffee habit and you'll be a millionaire.
It's the classic trope, yeah. And look, mathematically compound interest is a real thing. But the source actually dug into spending data from 2014 on to see where people's money really goes.
That's not the coffee.
It's usually not the coffee, it's a distraction. The source pointed out a couple of areas where trying to be frugal can actually backfire. First one was Airbnbs.
Oh, I felt this one. I remember when Airbnb was the ultimate travel hack. You'd get a room for like half the price of a hotel.
It was the value option. But the market's totally changed. The source makes the point that now, with all the cleaning fees, the service fees,
And the list of chores they leave you.
right, you often end up paying more than a hotel for way less convenience. You're paying a premium to take out your own trash.
So that hack is gone. What was the other one?
The other, and maybe funnier one, was bulk buying. They called it the Costco trap.
Uh-oh. I'm a big fan of the Costco run. Are they saying that's bad?
Not always. But for single people or maybe a couple, it can be a mathematical error. The speaker gave this example of being a single guy and buying like 48 eggs or 2 gallons of milk because it was cheaper per unit.
Look at me. I'm saving 3 cents an egg. I've done that.
We all have. But then what happens? 2 weeks later, you're pouring that second gallon of milk down the drain because you just can't get through it.
Right. Unless you're living a real-life Rocky training montage, nobody's eating 48 eggs that fast.
Exactly. And that's a bad frugality. You're solving for unit price, not for waste. You're literally wasting dollars to save a few pennies.
Okay, so, noted. No more bulk milk for me. But this is where the conversation got really interesting. It shifted from eggs to car insurance, and this felt like a genuine, insider secret.
This was a fantastic detail. The speaker moves to a new city, and his driving plummets from, say, 15,000 miles a year to just 3,000.
Okay.
He calls his insurance company, tells them, and boom, saves $40 a month, instantly.
But that part's pretty standard advice. The real aha moment was something else, from a guest who used to actually work in insurance telesales. That part sounded, well, it sounded a little shady.
It's not illegal, but it's one of those things they definitely don't want you to know. This guy explained that we think some algorithm just spits out a price. Computer says $500, end of story.
Right.
But that's not how it works. The agent on the phone is actually looking at what he called a profitability slider.
A literal slider on their screen, like a volume control.
Yes, a bar on their screen. And it basically measures how easy or hard the sale is. If you're pushing back, if you're complaining about the price, or if you say you're going to call a competitor,
They can move it.
they can slide that bar to the left. It might cut into their commission a tiny bit, but it drops your premium right there on the spot to close the deal.
Hold on. That makes me so mad. So if I'm just polite and I say yes right away?
You're paying the easy customer tax.
Yeah.
If you just agree, they slide that bar to the right. They might even just bundle in breakdown cover, assuming you won't even notice.
So the takeaway isn't just to shop around. It's to be a difficult customer.
For this specific thing, yes. Loyalty is a financial mistake with insurance. It's a commodity. You have to give that agent a reason to slide the bar left. Put them in a bidding war. If you just auto-renew, you're doing their job for them.
I love that. Be the hard sell. Okay, so that covers the cost side. But you said the real shift is solving for income.
Right. And this is just, it's pure math, but we ignore it. You can only cut your expenses to zero.
Yep.
That's the floor. But income, there's no ceiling on income. It's infinite.
The source used this phrase that stuck with me, penalizing yourself.
Yes. Think about the sheer amount of mental energy it takes to save money that way. Never going out to eat, never taking an Uber. It requires this immense discipline. And for what? To make your life a little more miserable every day.
Sounds exhausting, just constant low-level stress.
It is. And the argument is, what if you took that exact same amount of energy and discipline and you pointed it at increasing your income? A side project, negotiating a raise, learning a new skill. The return on that energy is infinitely higher.
Which brings us to time arbitrage. I have to admit, when I first read this part in the source, it kind of rolled my eyes.
Let me guess. The example of hiring a driver for your commute.
Yes. I'm thinking, okay, sure, I'll just call up my chauffeur. It feels so disconnected from the average person's reality.
And on the surface, I 100% agree. It sounds like pure luxury. But the source really breaks it down as a math problem, not a lifestyle one.
Okay, so walk me through the math so it doesn't sound like a flex.
Let's say your time is worth $50 an hour. That's your value. If you spend an hour sitting in traffic, you've just burned $50 of your potential value to save, what, the $20 cost of an Uber. You've actually lost $30 by driving yourself.
Because you could have been working in that hour.
Or sending emails. Or solving a problem that saves your company $1,000. The speaker in the source, who runs his own business, realized his time was worth maybe $500 or $1,000 an hour. So driving for 90 minutes every day was costing him a fortune in lost productivity.
But, and this is the huge, but it only works if you actually use the time productively. If you just get in the Uber and scroll through Instagram, you're not arbitraging anything.
That is the critical point. You're just spending money then. And the source was clear. This entirely depends on your stage of life.
Which is a very polite way of saying, don't do this if you're broke.
Pretty much. If your hour is worth $20, packing your own lunch is a great financial decision. If your hour is worth $2,000, spending 20 minutes making a sandwich is a financial loss. It's about knowing which side of that line you're on.
Got it. Okay, let's switch gears to the mechanics of money. The source talked about the two S's, the two big mistakes people make.
Right. Mistake number one, spending all your money. That one's pretty obvious.
Spend more than you make, you go broke. Check.
But mistake number two is way more subtle and, the source argues, maybe more dangerous. And that's saving all your money.
Saving is dangerous. That
Yeah.
feels wrong. It feels responsible. You put money in the bank, the number is safe, you sleep at night.
It feels safe, but it's what the source calls a guaranteed loss. It's the slow leak.
Explain this.
It's the concept of your real return. If your bank is paying you, let's say, 0.5% in interest, but inflation is at 3%,
Your money is shrinking.
your purchasing power is shrinking by 2.5% every single year. It's an invisible tax.
They had that brutal example of the friend with $1 million in cash.
Yeah, a freelancer. Saved up $1 million, was terrified of the stock market, so he just kept it all in a checking account. He thought he was safe. But at 3% inflation, he was losing $30,000 of buying power a year. He was basically lighting it on fire.
That's painful to even think about. The number in his account didn't go down, but the world just got more expensive all around it.
That's it, exactly. You're losing without even realizing you're losing.
So what's the alternative? The source used Microsoft as an example.
A perfect example. Does a company like Microsoft just sit on a giant pile of cash? No way. They hold very little cash. They use it. They buy other companies. They build data centers. They buy back their own stock.
Because they know cash is a depreciating asset.
They know it debases over time. Hard assets or productive assets like a company, they tend to inflate with the currency to protect purchasing power. So the lesson for you is you can't just be a saver. You have to be an investor.
Which leads to the mindset difference. Rich people, the source says, they just think on a totally different time horizon.
Decades. They think in decades, while most people think in weeks or maybe months. It's that classic delayed gratification. Do you want $1,000 to become $10,000 over 20 years? Or do you want to bet it on the football game tonight for a quick thrill?
But it's not just about willpower, is it? The source was pretty direct about the system being rigged.
It was. They talked about something called non-recourse loans.
Okay, what is that? It sounds like some kind of magic money.
It basically is. A non-recourse loan means you, the borrower, aren't personally on the hook. If you get a mortgage and you default, the bank takes your house and they can come after your other assets.
Right.
With a non-recourse loan, if the deal goes bad, The bank takes the collateral, the building or whatever, and that's it. They can't touch the rest of your money.
That's a heads I win, tails the bank loses situation. How do you get one of those?
You have $10 million in the bank, and you pay huge fees to investment banks. They want your business, so they offer these deals you and I can't get.
So is that it? The system's just broken for the rest of us?
No, and this is the really interesting hack they offered. You don't have to play that game. The reason the wealthy get those perks is because they're paying massive fees for all this active management.
Okay.
The source argues that you, the regular person, can actually get better returns just by avoiding those fees. Buy a simple index fund. Hold an asset yourself. You're cutting out the entire Wall Street complex and that 2% fee they charge every year, which can eat up half of your potential gains over a lifetime.
So you can just opt out of the rigged part of the game. I like that.
Yeah.
Now, I want to pivot to what I thought was maybe the most surprising part of this whole discussion. We talk about assets, stocks, real estate, but they talked about relationships as an asset class.
This was my favorite part, too. The argument is that relationships are probably the most undervalued asset in building wealth. And they were really careful to say this isn't networking, not that kind of gross transactional thing.
Right, not just passing out business cards at a conference.
No. They told the story of Harry Stubbings, who has the 20VC podcast. Now, he's not Joe Rogan. He doesn't get tens of millions of views. But he has deep, 2-hour conversations with the wealthiest, most powerful people in the world.
So that proximity is worth more than the raw numbers.
Infinitely more. He raised a $750 million fund based almost entirely on those relationships. He turned social capital into actual financial capital. He has fewer eyeballs, but the eyeballs he has can write massive checks.
And then there was that other story, the coffee shop networker. That was unbelievable.
Devesh Makhan. Such a great story. He's a junior banker who gets hired right as the dot-com bubble bursts. He shows up for work, and a month later, poof, everyone's gone.
But they didn't even fire him.
He was too junior, too cheap to fire. So he had no boss, no work. What did he do? He just went to Silicon Valley coffee shops and started talking to other people who looked like they were building things.
And who did he happen to meet?
Oh, just a few guys. Mark Zuckerberg, Reid Hoffman, before they were famous. He just made friends with them when they were nobodies, when no one else wanted to talk to tech guys.
And now?
Now he runs a firm called Iconic that manages the wealth of all those titans. His entire career was built on the relationships he made in coffee shops when things looked bleakest.
That's incredible. But again, I can hear people listening thinking, great story, but I'm not going to run into the next Zuckerberg at my local coffee shop. What's the system for us?
This is the critical point the source made. We all have systems for our money budgets, apps. But almost nobody has a system for their relationships. It's just left to chance.
So what's the system?
The strategy is simple. Karma flows back. You have to stop asking, what can you do for me? That's extracting value. You have to start asking, how can I help you? That's adding value.
They gave that great specific example with a WhatsApp introduction.
Right. The host had an idea, and within 30 seconds, Harry Stubbings said, I know the perfect person. He didn't just forward a number. He immediately created a WhatsApp group with all three of them.
And what did he write in the group?
He introduced them. He praised the host to the investor, and he praised the investor to the host. He set the entire conversation up for success, and then he left.
He asked for nothing in return.
Nothing. But he just made a huge deposit of social capital into both of their accounts. Now they both feel indebted to him. That is how you build a real network. You pour value in, and eventually it flows back.
The give first model, it makes so much sense.
And it applies to anyone. Connecting two friends, remembering a birthday, sending a helpful article. It's investing in that relationship asset.
Okay, before we wrap, there was a quick point on geography. The difference between the U.S. and the UK.
Yeah, it was a small but telling point. That even for creators based in the UK, the data shows the US is where the money is. The audience, the sponsors, the revenue, it's all heavily weighted to the US.
So the U.S. is still the engine room for this kind of wealth creation?
It seems to be. The dollar figures are just bigger. It's a more friendly environment for that kind of entrepreneurial growth.
Okay, let's try and tie all this together. We've gone from learning to negotiate with insurance agents by understanding the slider on their screen to buying back our time to realizing our savings account is basically a leaky bucket.
And then realizing that our most valuable asset might actually be in our phone's contact list.
It's a lot, but I think the common thread through all of it is being intentional.
Absolutely. The standard advice is passive. Save your money. Wait. This advice is active. actively negotiate, actively invest, actively build your network.
Which brings us to our final provocative thought for you, the listener.
We talked about how discipline isn't just about not spending. It's about having the discipline to build systems.
And specifically, a system for people.
Exactly. The source pointed out that you probably budget your finances, but you leave your most important asset, your relationships, completely to chance. So the question for you to think about is this. If your network is your net worth, why are you treating it like a lottery? What would a relationship budget even look like for you? Who are 3 people you could help this week with absolutely no expectation of anything in return?
That's a powerful question to end on. Stop solving for cost, start solving for income, and start investing in people.
That's it in a nutshell.
Thank you for listening to today's episode, and don't forget to like, subscribe, and share your ideas for future episodes. See you next time.